We start, all right, setting up the screener. So you go to FinViz, click on screener, all right, and then you want to make a filter for yourself. First thing I do is make sure price is below the 20, below the 50, and below the 200. So we clearly know that it's in a bearish market for sure. I want the recommendation to be buy or better. I want the RSI to make sure that it's not overbought. So I want it to be in an extremely deep price, but not still on a decline potentially. I want it to be coming out of overbought territory, so that way I can kind of catch it in the stage one, going into a stage two. And you can also change this to overbought if you want. All right, but I'll just make sure that it's below 50, and so that's there. So you could make sure it's below. It's not overbought, meaning that it hasn't gone up into overbought territory, so it's not going to potentially drop when I get into it. All right, so oversold is cool. If you want to have it oversold, that's fine. All right, it doesn't have to be deep oversold. As long as it's not overbought, it's good. I don't want to buy anything that's overbought. All right, so that's what that's for. Volume, I want the volume to be over 1 million, just because I don't want to get into anything that is on the extreme decline and the volume is low. Because if we're talking about investing long term, you may be putting yourself in a situation where you could it could be hard for you to exit out of your position, possibly, especially if you're talking about investing in individual companies. You never know what could happen with an individual company, especially in this climate. If you're looking at ETFs, it might be a little different, but you just don't want to get into anything that's going to be hard to get out of. So I always put over 1 million. All right, and target price. You can adjust this. It doesn't necessarily have to be 20%. It just has to be above where the price is at right now. I don't want to buy anything that's overvalued. The prices are above the value of what people think it's going to be. So I want the value to be below the price. So 20% and up is cool for me. All right. So as far as looking at the actual assets itself, if you want to look at ETFs, this is specifically for stocks. Let me see ETF. I know you can look at sectors. All right, that could help you out. You can look at yeah, I'm not sure if you have anything that dividends. So you want to look at dividends. Definitely make sure you filter this out so you can make sure that the dividend yield is something that you that's interesting for you. So you could easily filter that stuff out according to the dividend yield. All right, and let's say for instance, um, we want to look at dividend yield and look at let's say over over 5% just to see what pops up right now. All right, so you have two pages, and obviously um, these are not ETFs. All right, these are individual stocks. But if you filter it out using let's just say if you filter it out using sectors, you can do that. All right. So we can look at sectors and look at the sectors that may be the most promising. All right. Obviously, energy is going to be the best right now, and probably going into the future as well. Financials, that's maybe. All right, but energy, definitely. Utilities. All right, utilities, energy to me are always good ones. Um, Healthcare was big because we were dealing with COVID. So tech is cool, but the tech industry is not really doing well right now. A lot of major companies have been having a lot of layoffs lately. So that might be a little risky to play with. All right. Consumer stuff is all dependent on this whole inflation situation that we're dealing with right now. So that might be a little difficult to um, see a benefit from at this particular point. But it is something that may be helping you out long term wise. And so basic materials, energy, and utilities are usually going to be good ones. Energy, all right. So it may be hard to find anything that's on sale in the energy sector because it's one of the hot sectors right now. Utilities, all right, these are a couple of stocks there for that. And then basic materials, all right, not too many either. So those are good sectors right now. Obviously, looking at some of the sectors that aren't doing as well, all right, could be a benefit for you. What is that Target? So Target, as you can see, Target meets all of our criteria. Again, this is not an ETF, but it is in this in this um in this sector. So if you look at all these different sectors and you see, I'm looking at one sector and I got 2 pages of stocks, then you should probably just go to ETF.com and find the sector that correlates to that, or sorry, the ETF that correlates to that sector, and see if that specific sector meets these criteria as well. So you could use these criteria on your actual chart and plug in the ETF that you may be looking for. And then obviously, if you're investing for dividends specifically, you want to make sure you understand that. But you could use this to help you find individual stocks, and those individual stocks are usually going to be inside of that specific ETF. So that can help you out. All right. So if you look at Target on the chart, let's see. All right. Let's look at. I should have Target on my actual watch list. Uh, nah, it's not on there. So TGT. All right. So as you can see, pretty big sale on Target, big time frame because you're talking about investing. So investing, you're looking at bigger time frames, monthlies, weeklies. All right, as you can see, double top at that. All right, right there. Possible double bottom right here. All right, price is right above the golden zone, below the 38% level. This could be a good opportunity for a buy. All right, it's possibly a good opportunity for a buy. Excuse me. All right, nice trend on that. So support. All right, price is definitely hitting support. All right, so that's Target. So what sector is Target in? All right, so if we look at, let's go to ETF.com. Excuse me. Let's see what ETF Target is in. All right, all these different ETFs with Target in it. All right, so target exposure. All right, so SPY is there. IVV, VOO, VTI, VTV are the most, the biggest ones, obviously. All right, and then you have some funds on this side. All right, you got some ETFs on this side. So retail ETF here. All right, consumer discretionary, blah blah. So consumer discretionary is something that you could potentially look at, and then in this case, you want to make sure that you are looking at the dividends. So distribution yield 85%. All right, the next ex dividend date is June 19th. All right, so basically 85% of whatever you invest in there per share. So 85% of the share that you get, each share, all right, 85% of that. And then you can go to Yahoo Finance to figure out what exactly that number is, but it should be here. All right, somewhere here, the exact number. So we can look at XLY on the chart. XLY. All right, and as you can see, it doesn't look that different from the S&P. All right, so you can see it's in the golden zone right now, bigger time frame. All right, looks like a double bottom. So you're catching it at support. So that's basically how you do it. So in this case, there's your setup right there. All right, bigger time frame setup, real nice pennant structure with a double bottom. Perfect, 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 perfect. All right, so you got support right there. You want to buy at support, so you want to get in and establish a position here. So it's $142 per share. You start buying shares now, buying, buying, buying. So when it takes off, you're good. Now, as far as the dividends on this, all right, the dividend here, you get 33 cents per share that you own. So 142, we do 33 cents divided by 142.81 right now. So what's that? A 2%. All right. So you talking about making 33 cents per. So now you have to ask yourself, how much do you want to be making on your dividends? What is your desire as far as income on your dividends? So if they're going to pay you every quarter, all right, how much money do you want to make per year? Let's say you want to make $500 a year. Divide that by 4 quarters. That's $125 per quarter. All right. So in order for you to make $125 per quarter, you need to make, how many times can you get? So 378 shares. So 378 shares times $142 is 53,000 shares. All right. And if I go over the math again, let's make sure. Let's just do 53,000 shares. All right. Times, we don't need to know that. 53,000 shares. Let's do $142 times 53,000. All right. So that is, hold on, let's make sure this is right. I'm just trying to make sure my math is right. So 33 cents per share, and you want to make $100 and something. All right, divide that by 33. It's 303 shares. 303 shares times 142. All right, so that's $53,000. My bad. So $43,000 it will cost you in an investment in order for you to make $100 per quarter using investing like that. All right. And if you want, that's all about the dividend yield. So when you look at the dividend yield and it has a percentage of, point zero something or point something, that's not, to me, that's not a good, because you can get a higher yield than that going at individual companies. ETFs are going to give you very, very low dividend yield compared to individual companies. So I like looking at Realty, for instance. If we do a comparison, you could say, first of all, they pay monthly. So that's about 25 cents per share, and it's trading at $63. So if I use that same analogy and say I want to make $100 in this case per month because they pay monthly, how many shares do I need in order for me to make $100 a month? If they're paying 25 cents, that's 400 shares. All right, 400 shares at $64 is 25,000. So I'm going to make way more money investing in Realty than I would in an ETF, because the yield is way bigger in the comparison. So let's go to Yahoo Finance so you can see the actual yield. So what were we looking at? XLY dividend yield is 0.84%. All right. Compared to Realty income, dividend yield is 4.60%. Huge difference. 84.84%, 4%. Huge difference. You feel what I'm saying? So when you understand that, now you understand how to use this. So if you want to get more bang for your buck, you may want to make sure that you get something that's over 1%, because essentially what you're talking about is getting a 1% or more return on your money. For every dollar that you spend, you desire to get a percentage back. For every share that you own, you want to get 1% of what you spent back or more, basically. All right. Old Realty is giving you 4% or higher. The ETFs that you may be looking at are probably going to give you less than 1%. All right. So another thing that you can look at is I think it's dividend.com. Let me check. Dividend market beat. No. That's not it. Is that it? Oh, let me see. Yeah, that's it. All right. So this is the ex dividend calendar, but we want to look at we want to look for dividends, a dividend screener. Boom. All right. And you're looking at ETFs. I'm assuming that you want to look at ETFs because you feel like those are safer. Yeah, but the ETF is only strong if the stocks inside of the ETF is strong. So you can make your own ETF. All ETF is a managed fund. That's it. So all they do is pick the stocks that they feel are going to be good returns, and they pull them into one fund and they manage them. If the stock company isn't doing well and it isn't generating proper returns, they'll 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 minimize their holding of that potential company, that specific company. So if we look at XLY and you look at all the holdings in XLY, and you see that you have Amazon, Tesla, McDonald's, Home Depot, Nike, Lowe's, Starbucks, blah 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 blah, you can just you could just get shares of all these companies. You don't have to invest in XLY because they're going to charge you for their intellect. So they feel like they're smart enough to put this together and know that Amazon should be the biggest holding, Tesla should be the second biggest. Then, McDonald's, blah, 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 blah. All right, if Amazon isn't doing well, they're going to trim this down. So it's not going to be 19%, it's going to be less. If Nike's doing better, they're going to buy more. They're just managing this. So you could do the same thing. If you buy this entire thing, you're going to get 0.0884% return on your money. But you still have the risk of actually not getting the return based on the movement of the ETF. So if the ETF isn't moving the way that you want it to move, you're still going to get those losses, right? But if you invest in the individual companies and make your own version of the ETF and manage it properly, then you can get the full dividend, not a piece of it, without the fees, and then you can make decisions on whether you want to slim that or not. That's why I teach trading, because when you're trading, you can have points where you trim your position. We call that take profit, right? So you can use the screener to find what you're looking for. So we could just take any of them out and just go for, if we want to get whatever, let's say 2% return. All right. Now you have all of these different companies that you can look at that can give you the return on your money, and they're on sale. And you can combine them into your portfolio and make your own ETF inside your own portfolio. Because that's all it is. It's like a cheat code, but you're not cheating because you're getting a piece of the return. You're not getting the whole thing. They're only giving you 0.84% return. If you do it yourself, you're going to get the whole dividend, and then it's going to be multiplied because each company that you put in your portfolio is going to be paying out its own dividend. So if we use a dividend screener, and we can say we want 2%. All right. We don't need to worry about sectors and all that. Consensus rating, let's say hold minimum, right? Payment schedule, quarterly. If you want quarterly, put quarterly. If you want monthly, put monthly. 52-week range, we want it to be, 50% sale. All right, consensus upside 20%. It's basically the same criteria that we put in the screener on FinViz. All right, and whatever. Let's see what else. What else? Payout ratio. We don't want the payout ratio to be too high, but we can leave that. All right, consistent dividend growth. If you want to look at the consistent dividend growers, you want to look at the Dividend Kings and the Dividend Kings list and the what's the other one? All the stuff, all the stuff we talked about in the old courses or whatever. But the Dividend Kings list, and there's another one. It'll come to me soon. All right. So yeah, let's just go. Let's just show 50. All right, and see what comes from this. And this is free, so I don't know if it. All right. So you got all these companies. All right, and then you can categorize them according to the highest dividend yield. So ISCL is giving you 10% of your money. 9, 8, 7, 6. So imagine putting all these companies in your own portfolio and manage the positions yourself using the criteria. So each one of these have a specific dividend yield, but we don't know which one of these are in a buy position. So that's why I like using the FinViz, because I can see the chart that it shows me that it's in a buy position. You feel what I'm saying? So, we got anything that can go over 5%, right? Which a lot of people say the highest number is going to give you the most risk, which, can be, it can be true. It can be true. All right. But it all depends on what you're looking for. So you see, it's not that many on here, but remember, I average the volume is there. Buyer better is here. So if you change these things, you're going to get more. All right. So holder better. You're going to get more pages. All right. Over 1 million. I still wouldn't change that. Keep that there. All right. And if you want to get a little bit more information, you could push overview. No, go to basic. All right. That can give you a little bit more information. And then you can go to, which one is it? Which one is it? Which one is it? News is cool because now you can see uh, all the updated news. You can just go through the news and see what's going on with the company. But the one I'm looking for is technical, performance, ownership, financial, evaluation, basic, TA. Is that it? No. Snapshot. Yep, that's it. Snapshot. Go to Snapshot and you can get a description on what the company actually is. And you can do your research and see if it's something that you really want to get into. Right. All right. But I mean, simple thing, okay, we just looked at XLY. So XLY is consumer discretionary. So we can go here and go to consumer discretionary. So you got consumer cyclical and consumer defensive. All right, either one of these. Consumer cyclical, boom. All right, you got one page. All right, and that's because the dividend, you're not going to get that much usually. All right, consumer defensive, how many you got? All right, you only got one. All right, there's only one that's going to pay you that high dividend. So, as long as you're getting over 1 or 2%, I think that's something to work with. Target is going to give you how much? 2.41%. That's not bad. It's not bad. Tyson Foods, 2.86%. It's not bad. So you could have Tyson Foods and Target in your portfolio right now and be making over 2% return on your money instead of going in for an ETF that's going to give you 0.84%. That's just me. I'm trying to always make my money work, but get the most bang for my buck that I possibly can. That's what I'm about. You feel what I'm saying? So that's for that. So you might have some that's in consumer defense. You could go through this list and just find companies that you are familiar with and create your own ETF in your portfolio. You don't need to just pay for ETF and just try to set it and forget it, because you're not going to get the money that you think you're going to get. You're going to have to invest six figures in order to get, what I mean? You have to invest $1 million in order to make a living off of dividends when you're dealing with ETFs. It's not the purpose. You know what I mean? The ETF dividend is like a bonus. It's not the purpose. Individual stocks, okay, now we talking. All right. You pick the right ones and you get the return that you're looking for. Now you put yourself in a position to where you can actually earn a living off of your investment. Over 10%. Who's paying over 10%? All right. You get to see which companies are paying that high dividend, and do your research and figure out what is it even beneficial for you to think about investing in these companies. Most of them probably not. All right, most of them probably not. All right, but 5%, I'm sure you can find a couple solid companies in here that are at a discount that pay a good dividend. And if they are on a decline, you have to assume that when the stock price starts to go up, the dividend yield is probably going to drop a little bit too. That's how it goes. So when the dividend is high, it's probably because they want to entice people to invest. When the dividend is low, it's probably because it's super solid and stable. That's why the ETFs pay such small dividends, because it's about stability. You feel me? But if you know how to trade, it doesn't matter, because you know how to get in and get out when the time is right. If you get into a stock and you're getting paid dividends for 2-3 years and you see on the weekly chart it's overbought, you probably want to, trim your position down a little bit, because you know it's about to decline. Take that money, move it into something else that's on sale, and just manage your portfolio like that. That's how I manage my HSA. That's how I manage my daughter's custodial accounts. That's how I manage, you know, long-term investment portfolios. That's how I don't put my money into ETFs. I pick individual stocks. I get paid dividends, and I manage those positions according to bigger time frame charts, monthlies, weeklies. All right, and I use these screeners to help me find those opportunities. And when I got time, I'll do the research, find some stuff about the company that I like, find some stuff about the company that I don't like, and make my decisions based on that. Because you're only going to know but so much. You know what I'm saying? So that's pretty much what I do. So FinViz, all right, ETF.com, if you want to go into that, go that route. All right, Yahoo Finance also gives you, good information on what each individual company is doing. Obviously, that's always a good resource for us. And then MarketBeat.com gives you an easy filter to use, or easy dividend screener to use, to help you find not only companies that pay very good dividends, but they also give you financial calendars like dividend X dates. So that way you can make sure that you buy in at the right time so that you can get that payout quicker. All right. Dividend Kings is what I was. Dividend Kings and Dividend Aristocrats. Those are both the ones I was trying to talk about. Dividend Kings, boom. These are companies that are index list of stocks that have consecutively increased their dividend payments over the last 50 years. These are most solid dividend paying companies. All right. Altria Group, huge. Triple M, huge. All right. Realty Investment, ex dividend date. You see them coming up. All right. Payout ratio, you don't want it to be super high, but if it's on this list, I'm going to bank on it. All right, annual payout. They're paying $3.76 per share that you own, and each share is only $43.46. Right now, they're on sale. 12 years straight increase on dividend. All right, make it simple. So create your own ETF. I'm not going to advise you to invest in ETFs when I know that the information that I gave you access to will allow you to create your own ETF per se, your own portfolio. You could just focus on Dividend Kings only and create a portfolio. All you need is 5 or 10, and just manage off that 5 or 10, but buy them at the right time. Target, may be time to buy a Target. All right. Coca-Cola, check to see if it's on sale. Obviously, Target has the biggest discount, 11.9%. So Dividend Kings and Dividend Aristocrats. All right, S&P 500. These are companies that have increased their dividend payments consecutively for the last 25 years. In order to be included in the S&P Dividend Aristocrats Index, a stock must be a member of the S&P 500. So we look at the S&P 500 every single day. We know when it's going to be up. We know when it's going to be down for the most part. The individual companies that are in this are the ones that pay the strongest dividends. All right. So you can see the list is pretty extensive. But again, all we're going to do is filter exchange. We want to go for the biggest dividend paying companies. All right. All you need is 5 or 10. You don't need a whole 30, 40, 50 companies in your portfolio. 5, 10 strong companies that pay good dividends, that got very good sales, and then you just manage them and rotate them. That's it. All right. So definitely use this information, and you'll be good to go. Any more questions? Just let me know. All right. Thank you.